And Franklin, welcome to the show.
Thank you. Thanks for having me.
Yeah, I'm really excited to talk about this topic on SBA loans, kind of all the nitty-gritty details. Before we do that, let me make sure compliance and legal is happy, and let me read my disclosure. eWealth Partners is an investment advisor registered with the state of Minnesota. The information in this podcast is educational and general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. Determine what strategies or investments may be suitable for you and consult the appropriate qualified professionals prior to making a final decision. All right, with that out of the way, let's just start with, can you just give like a quick overview, SBA versus conventional financing
Yep.
for the purpose of buying a business? And actually, what does even SBA stand for?
Yep. SBA is Small Business Administration. So it's a government program that's run through the banks. And essentially, it gets banks comfortable with doing unsecured financing. So because they will provide a 75% guarantee on these loans. So that's the biggest difference between conventional and SBA financing is that it really what I just said, it gets banks comfortable with unsecured financing. So the SBA is just going to allow a longer payment terms and lower down payments. So it's easier to buy a business.
Okay. All
Yep.
right. And so I think you said that in the few, but what are the advantages? I kind of can see it from the
Yep.
bank side that they're, kind of de-risking in a sense.
Yeah. Yeah.
Um,
Yep. I can totally tell you this. So with a conventional loan, if you go and try to buy a business with a conventional loan, you're typically going to have a 5 to 7 year amortization. So, with an SBA loan, you're going to get up to 10 years when buying a business. So if you think about that, what your cash flow is going to look like on a shorter term, it's going to allow you to have stronger cash flows. Another thing is that with the down payment for a conventional loan, a bank's typically going to want, around 20 to 30% probably down. But the SBA allows, as little as a 10% down payment, even less in certain circumstances with the new SOPs that just came out in November. So that's the
oh,
biggest advantage for the buyers using an SBA loan is that longer term and lower down payment typically.
tell me why a bank wants more down in, you know, 5 to 7 years rather than 10 years. I think I know the obvious answer, but why don't they make it as attractive SBA? Because there's just too much risk.
It's too much risk. Yeah, they want to be paid back quicker because acquisition loans are risky loans. So that's going to be it's the same concept kind of as loan to value on a commercial real estate property,
Sure.
getting out of it, if
Yeah, okay,
something
that
does
makes
go
sense.
bad, you know
Random question here.
yeah.
Do other countries outside the US have their form of SBA loan? Do
I
you
don't
know?
know.
Any idea?
I don't know.
Hmm. No,
Sorry.
I don't do much international business. So now let's talk through, okay, now so an SBA loan might make sense in a lot of ways because you have a longer term to pay it off, less to, bring to the table at close. Should we talk through there's different types of SBA loans,
Yeah,
right?
yeah. So the SBA loan program, there's two types of loans. There's the 7A, which is for everything. That's for buying a business. That's for if you need to finance some working capital, equipment, commercial real estate. That's for everything. And then there's going to be the 504 program, and that's going to be just for commercial real estate and buying equipment. So for deals like these, for buying a business, we're going to be talking about the 7A loan.
Okay. All
Um,
right.
you can say, you're buying a business, say you're buying a bakery and you're buying the building as well. You can structure the loan in a couple different ways, actually, a few different ways. You could have it be all one 7A loan. You could have it be two 7A loans where you have the business and then the real estate separately. You could have a 7A loan for the acquisition, and then you could have a 504 loan for the real estate if you like. So, it all depends. There's lots of different reasons to structure loans different ways, but those are the two main programs. There's also something called the 7A Express, and those are loans. They're up to 500,000. They're typically what we use them for here at Scale Bank is a line of credit. to go along with when you're buying a business or just in general buying a business. So, but there's other ways to finance working capital as well. So you can finance that right in the 7A term loan too.
Okay. All right.
Mhm.
So maybe just talk me through an example that you have recently done or, in the past of, I don't know,
Yeah.
when did it make sense to split it between a 7A and then do the commercial real estate of the building into the 504? And when did it make sense to do it all? Let's just say in this case, business in real estate, all 7A.
Yeah. So when you combine a 7A, when you combine the real estate with the business, and the real estate is at least 51% of the transaction, part of the loan, then you can go all the way out to 25 years on that whole transaction. So keep in mind, real estate has a max 25-year amortization term. A business acquisition has a max of 10 years. So
Okay.
if that real estate, you can, however, I typically only like to encourage our customers to structure it that way if it's a cash flow issue where they really need to stretch
Ah,
out the amortization in order to make the deal work, because I think it's better if you can have the real estate on a separate loan, because coming to refinance that real estate, that's hard when you have the acquisition loan also as part of that, because with every acquisition for when you're buying a business, there's a big element of goodwill, unsecured financing. So if you were to buy a building and include the business in it as well, your loan to value is going to be terrible. And that makes for a hard loan to refinance in the future if you want to refinance it. Or, even it makes it difficult when you want to sell that building, perhaps move.
huh.
So I typically only recommend it, if it's a cash flow issue or if you're sure you're not going to want to refinance, get a killer rate.
So if I'm hearing you correctly, ideally, if we can cash flow it on the 7A, so now we're 10 years amortized, right?
Mhm.
Um, in that case, do you then have two 7A loans, one for the
But
business, one for the real estate?
yeah,
Or you could do it all together.
yeah,
Okay, and I'm sure that could be a whole, podcast kind of talking through that piece of
it
it.
can,
But
yeah. Yeah, we probably should do a separate podcast on 7A versus 504 for real estate because it gets in kind of deep. There's a
okay,
lot. 504s they're great products, but they can be a little bit complicated. But there's advantages and disadvantages to both types of loans that
okay.
we'd talk about for an hour if we wanted. But
If we're not using conventional through the bank and we're using an SBA loan, the expectation of what we would need to put down is about 10% or so.
yeah, I would say on average, sometimes banks will go a little bit lower, depending on the circumstances, depending on how much seller carries in the deal.
Hmm.
Sometimes if an employee is buying a business, that is a good case where putting down a little bit less seems to be okay. Um, so the SOPs were recently changed back in November, where that you can put down a little bit less than the 10%, and uh, they've left it up to the banks to decide. We should
Hmm,
probably quickly talk about that. When
sure.
you are getting an SBA loan, there's this universal, the SOP, and that's the government. It's like the Bible, I guess, to SBA, what all banks have to follow by.
Yep.
But every individual bank has their own policies. So they have to follow by SBA, but most banks are going to be a little more conservative on certain things. We all have our areas where we will take risk. So some banks are okay with doing more unsecured financing than others. Some banks, have stricter rules for different industries, such as like restaurants,
Hmm.
hotels. So just keep that in mind that if you talk to a bank and they say one thing, it might, have to do with their own internal policies. And
What's the
it's,
question that pot- buying business owner would
mhm.
ask the bank to even know? How would I interview the different banks and say, and how would I know any different? Would that be obvious, or would you just say, hey, this is the industry type of business I'm buying. Is this, your niche? Is this what you're familiar with? Or like, how is it
Yeah.
obvious to, yeah,
I
that's,
don't think it would be I've definitely had borrowers where they said, well, this bank told me this and this bank told me this. And a lot of the times, personally, what I do is I will take from the SOPs and I will copy and paste and I'll say, this is what this is what we follow. They have their own policy, so they're not wrong. They're not going to necessarily know unless they've been talking to a lot of different banks or they've been in business
Sure.
for a while.
And there's
Um,
probably only so much wiggle room, if there's the Bible here, like there's only so much. So it's like for the most part, like maybe
yeah,
it's on that piece of it. You just want to make sure you're working with a qualified banker that probably understands SBA loans. Not all banks even have an SBA arm. Is that correct?
yeah. I mean, some banks are what you're probably getting at is some banks are preferred lenders, some banks are not preferred lenders.
Okay.
At scale, we've only been a preferred lender for a few years, but before that we could do, some SBA loans. They just needed to be approved by the SBA versus if you're a preferred lender, you can approve your own loans.
Oh, okay.
Yep.
All right.
Yep.
All right. So now and when does the buyer engage with the bank? Is it what part
Yeah.
of due diligence? Like I feel like oftentimes it's probably later than they should. But yeah, when does a buyer engage with the bank, or when
In
should
my
they?
opinion, when they
Yeah.
start thinking about buying a business. Now, that's not always possible, right? Because things pop up. But the earlier the better, because we don't pre-qualify you, but we can certainly give you some tips. I look at people will send me, businesses are looking at buying all the time, and I'll just look at them and kind of give them my opinion or help them formulate questions to ask the sellers. And so the
Hmm.
earlier the better, like with anything. Talk to your attorneys early, your CPAs, any experts that can help you make the best decision you can make, because buying a business is a journey.
Okay. So it's you say it's fair game to even come up with maybe if the buyer's still in the hypothetical mode and hasn't maybe found that target purchase, that's something where it's okay to reach out to the banker just to say, hey, what would this look like? And then really what the bank is looking at is they want to look to see, at the existing business and say, okay, let's look at the cash flow of it, how profitable it is. Let's look at the purchase price and kind of in a sense doing their own internal valuation. And
Yep.
then we gone through this in the past. But then another big piece is the bank wants to know who that buyer is,
Mhm.
right? And kind of what's their story. Have they owned a business before? Are they familiar with this type of work? But maybe you just shed some light on that whole piece, like
Yeah.
the element of kind of understanding, like, is this business even worth buying? Like kind of like in the bank's eyes, and how that often probably times is different than what the seller is asking, right?
Yeah.
And then maybe just talk through like now when you're kind of interviewing the potential buyer, right? What are you, the bank, looking for?
Yep. 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 I would say you need to be prepared to sell yourself to the bank,
Sure.
because it's a lot of money they're going to be lending you. So, things to do to prepare: get your resume up to date or your LinkedIn profile up to
Hmm.
date. Try, if you don't have direct industry experience in the business that you're buying, you have to try to figure out how your experience translates into running this business. And if there are weak points in that, then you need to look at the business itself and say, well, are there some key employees? Is there management in place that's going to stay? You're going to also be thinking about, how long is the seller going to stick around to help me, in this transition? Are there people I might need to hire to replace that seller? Because with an SBA loan, if the seller is not staying in at all, they have to depart within 12 months. Gone. So they cannot be part of that business after 12 months. So you have to keep that in mind.
Why does the SBA not like that? I mean, you're not the SBA, but like,
I know.
I don't know, why is that such a concern that if they're basically on payroll for 12 months after the deal, what do they not like about that?
I think you're going to have to ask somebody else, Brian.
Okay,
This is one of those rules that I wish were a little more liberal, because
sure.
I sometimes do see value in the seller staying on for longer than that period of time. But recently, back as I talked about before with the new SOPs coming in, being implemented back, last year, they now allow buy-in. So really, if the seller wanted to stay in longer, they could retain a certain percentage of ownership and stay on indefinitely at any capacity, owner, employer, employee, whatever, whatever. So
Hmm,
I don't really know. I wish that rule were taken away. I'm sure there is some reason
sure.
why they do it, but
Sure. Okay. But maybe it's worth if the seller plans on sticking around on payroll for a long period of time, then okay, this probably isn't an
oh,
SBA
sure.
deal then. That might be a way to kind of
Yeah,
determine
that's
that.
one reason why we might as a bank. So prior to us becoming a PLP lender at our bank, we did do a lot of deals conventionally. And if that is a concern where the seller wants to stay on longer than a year, we do bring up conventional financing at
Sh-
times.
Okay, makes sense. And going back to the buyer and if they're qualified or not. And
Yeah,
so, the resume, probably a personal financial statement. You have to send
yeah.
them all your assets, debts, income, history, just like you would if you
Mhm.
tried to get a mortgage type of thing. Anything else that is worth noting?
Yeah, I would say when you're preparing that personal financial statement, I just want to back up on that. Make sure that you are including any debt that we may find on a credit report, and that would include anything in addition to your own personal debts. But if you co-sign for a vehicle for a child, or you've co-signed on student loan debt, anything like that, those can be deal killers at times because we look at global cash flow here in SBA. So
Yeah.
that can really have an impact on it. So make sure to have all that in order. Also, I would say with most acquisition deals, we are as a bank are going to be looking at something called you'll learn this term post closing liquidity. So we want to make sure that you have a backup plan in place. So in case the business is struggling to make payments, I mean, obviously banks are going to be looking for liquidity, liquid
Mhm.
assets. Obviously a lot of the times you're going to have assets that are more protected, like retirement assets. And I assume as you as a financial advisor wouldn't want them touching those. It's
Yeah,
not
in
as
the
liquid
eyes
as
of the
it
bank and the banker though, it is liquid. Yeah, I mean like ideally like
can
there
be.
could be some, tax and penalty piece, but
Sure.
the bank looks at that as like kind of this oh crap moment of where do they need to go. They'll look at
Yeah.
kind of all that those liquid assets. Yeah.
Yeah. I mean, we preferably would like to have a decent liquidity. Another thing to think about is sometimes if a spouse guarantees the loan and they have a decent job, having that outside income helps as well. So, but you
Oh,
always want to know like what's a second, you got to be thinking about secondary sources of repayment for these loans because underwriting
okay.
will
So
actually document that. Yes.
yeah, because I guess would it be fair to say you're married, you have a spouse, and if you don't need them on the deal,
Mhm.
should you keep them off? You only bring them into the deal, or is that kind of not necessarily cookie cutter answer, but is it you
Um,
bring the spouse to sign off if we just need their income typically, or is it there's not like a common case?
it just really depends. It depends on the deal.
Because now all these are basically you're signing a personal guarantee, right? Which I think most of us business owners understand. Like it's hard to get away from the personal guarantee until you grow the business, where they feel really comfortable with the cash flow and the assets. But more often than not, you're signing personal guarantees.
You
And the
are
personal
signing.
guarantee, what is the personal guarantee? Just
Yeah.
tell our listeners what is that?
Yeah. So essentially, if the business is having trouble making payments, obviously the bank will work with you. There's certain things you can do, defer payments or non-accrual, which is no interest, things like that. But if the business can't make the payments, they're going to look after those guarantors to, make those payments. So that's what it means, that personal guarantee. I personally guarantee I will pay this loan.
Okay,
And that
that
would
makes
be
sense.
before liquidating any collateral, or foreclosing on any secondary collateral that's been pledged in the loan.
Okay, let's go back up to the commercial real estate side because
Yep.
um, I remember looking with a client of mine
Mhm.
and they were going to buy the real estate as well. But the
Mhm.
issue that we had is that in this case, they weren't going to occupy more than 50% of the total building, right? Isn't that kind of a deal killer that if you're going to use an SBA, what's the number? Is it 50 or 51%? You have to be, your
51.
business has to be occupying at least 50% of it.
51. Yeah. But that can
51.
include, you can get creative with that though, Brian. So it can
Okay.
include
I
some
like
common
that.
areas. In certain cases, it can include parking
Oh,
lots, So, I mean, I've had a trucking
yeah.
business, of course. So, but yes, you are correct. And in that case, you'd have to either sell or finance that building or try to get it done conventionally, or possibly you're just renting that building then for a while until maybe for a few years until, the business has stabilized, you got some good cash flows proven out, and the bank can come in and say, okay, we're comfortable financing that conventionally now.
Okay. Yeah. And that is actually worth talking about too, is like, we think a lot of times of using an SBA loan to buy the first business,
Mm-hmm.
but
Mm-hmm.
it can be used as an acquisition strategy, right?
Absolutely.
Buying, acquisitions down the road. And just as your example, buying property down the road that wasn't maybe part of the initial price tag, or you found some other property. So just talk through that.
Yeah.
Now you're an existing business. How have you seen business owners then use SBA
Yeah.
when they're whatever, 1 year, 2 year, 20 years mature and using an SBA?
Yeah. I mean, I just closed a cleaning company down in southern Minnesota, and they've decided to not buy the building that the business operates out of now. So they put together a short-term lease for that building. And I do expect, in the coming years for them to come back to me and say, okay, I'm ready to buy this building, or I found a different building to buy, to
Hmm,
operate store my equipment and whatever out of. Second locations. I mean, it can be as simple as
well,
a nail salon. You want to open a second one, a hair salon, then you can come back and open that second location. Maybe you just want to add on to your building, and that's
sure.
another thing you can do. So absolutely.
And
If you are opening a same concept second location, that would be in the SOP, in the SBA SOP, that would be defined. That would be the definition of an expansion. So in that case, you might be able to get away with less down. I just want to,
oh, less than okay.
yeah,
Is
yeah,
it a whole new loan though? Like it's not like you can modify your current loan. Is you have to do a whole new loan and go through
it
that
would be
process
another
again?
loan. Mm-hmm. Mm-hmm.
Okay.
Yeah.
Um, and we often hear that isn't, SBA or these government loans isn't just a lot more additional work requirements. What's what's the case on
Oh,
that?
yeah. I mean, there's definitely more requirements. I think the biggest one you're going to hear is paperwork. Um, and I guess there's some truth to that. We do have a list of things that we're going to need, but you're going to need all the same things pretty much with a conventional loan as well. There's might be a couple extra forms that need to be filled out. When buying a building, environmental reviews might be a little stricter, things like that.
Sure.
But in terms of costs, I would say that the only thing that's really going to cost you more on an SBA loan is going to be there's an SBA guarantee fee, and that's for loans that are over $1 million right now. They might change that. It's last year they did change that. They increased it to 1 million. And then it's about 3%. You can Google and get an SBA loan guarantee fee calculator if you're curious, but it's about 3%. And that fee is always financed in the loan itself. So basically, what that fee is, if the bank has to go to the SBA to collect on their loan, then those fees are essentially used to pay off the banks if they
Got
need
it.
to collect on their guarantee. So that's basically what that is.
What other fees are,
Yeah.
I mean, obviously you have the rate, the term, you have
Yeah.
essentially, I'm going to call it this origination kind of fee type of thing. What other just common fees should they anticipate?
Yep. You should anticipate any fees where it costs the bank, any reports that need to be ordered. So such as
Sure.
an appraisal, a business valuation, UCC search fees, UCC filing fees, maybe some sales tax if you have vehicles involved in the purchase. Anything that costs us money, we would pass on to the customer.
Mm,
And then there's most SBA lenders, and I'm talking most, like probably if I were to guess, 95 to 99% of SBA lenders charge a packaging fee. And that's up to $2,500. There are certain circumstances where you can charge more, but mostly it's a $2,500 fee. It covers the loan docs.
sure.
Sometimes, especially smaller banks will use outside preparers to prepare their loan docs or attorneys on bigger transactions. So that helps to cover that. You might see some attorney fees on the loans. Yeah, just normal stuff though. Title fees, buildings, when you're buying that
So if
building.
the let's go back to the appraisal, the valuation piece of it. So the bank is, are they going to do a valuation appraisal on every deal, regardless? What's the smallest amount of the SBA loan you can do, and what's the largest
Yeah.
amount? Is there a min max at all?
There's not a min, but I will tell you that, yeah, I want to keep them over 150,000.
Yeah,
I will do a couple small ones a year, but it has to do with banks' resources too,
right.
and yeah,
That
I
makes
think,
sense. I mean, I think we all know that on the personal side of it, like, is
yeah,
it, there's someone
yeah.
on the other side, the banker that has to go through all this work, and if the loan size isn't there, it'd
And
be
they're
worth
the
your
same
time.
amount of work for us regardless. So pretty much. And the max SBA loan is $5 million. So
Is
we
five
don't do
million?
too many of those. I would say the average SBA loan is somewhere between 750 and $1 million.
Okay, but it can go up to 5 million. Where is a potential buyer disqualified? Isn't there something that if their net worth exceeds a certain amount, or maybe like their liquid assets exceed a certain amount, they don't qualify for SBA? So basically, that you got too many assets, too much
Yeah.
income, where they're like, no, you should just self-finance it. You got the money, or tell me when another
Yeah.
place where they disqualify because their balance sheet is almost too strong.
Yeah, you might get a couple different answers depending on who you talk to here, but there is no longer a personal liquidity test that's
Oh, there
required for
isn't.
SBA. No. But a bank also has to keep in mind, is there credit available elsewhere?
Yeah.
That's a test we have to do on every one of these SBA
Hmm.
loans. If so basically they would have to disqualify them,
Interesting.
conventionally in order to get it done. Now, that's fairly easy to do on most cases, for most cases. If you look at maybe somebody does have a lot of money, but it's in a trust and it's not readily available, there's your credit elsewhere.
Got
So
it. Interesting.
yeah, I think the bank also has to use discretion. Is this good use of a government program?
Okay.
Now, this is a great government program. Don't get me wrong. I mean, it's a program. I'm pretty confident saying the Republicans and Democrats probably agree that it's a good
Yeah.
program out there. But you still have to, keep in mind the purpose of the SBA program,
Yeah.
and it's to help people that were not born into, extreme
Yeah.
wealth, create wealth for themselves and generate and create jobs,
Yeah.
you know,
Exactly. And that's kind of the beauty
yeah,
of it is
it
you have a
is.
financing partner, and it,
Yeah.
takes off risk from the bank, and it going back to the 5 million loan
Yeah.
size max, is that per loan? Could you stack these? It's an aggregate. Just a random kind of thought here too is, what if a business owner is like, I'm going to buy this business, and I hope to be out of this business. I want to turn it around and sell it in 3 years, 5 years, 10 years. Or maybe I'm going to run this thing for the next 20 years, and they get some great offer, maybe not the next day, but 2 years down the road. How does that impact it? Does it? Like, can you exit the bit, like basically pay them the money, what's left on the balance, and you're done with it? Is there a prepayment fee in that case if you sell the
No,
business? Okay.
no, there's no, as long as the SBA loan is under 15 years, there is no prepayment penalty. And I'm talking about 7A here.
Okay.
Um, so the only time you're going to have a problem there is if you blend that term. Remember what we were talking about at the beginning of this podcast was if you blend the term, if you have a, commercial real estate and it's 51% or greater of the whole loan, then you can go up to 25 years, even on the acquisition piece as one loan. You might run into a problem there, but still the prepayment penalty is only for 3 years. So if it's after three
Oh,
years, fine. And even then, even before, if you want to pay down that loan a little bit early, if you do have a loan over that 15 years, you can
hmm.
still pay off 25% of the principal balance per year without penalty.
Okay, so you could
Money's
be
a great
pretty
program.
so you could be pretty aggressive if you're like, hey, cash
Mhm.
flow and okay.
Yeah.
Hmm. Let's talk about the rate. What is that currently,
Yeah.
and what's going to happen in the future? No.
Yeah. Well, it
But
depends again what bank you're at, and the
yeah.
bank's liquidity position, I think, sometimes has a lot to do with the rates that you're getting. But what I will say is, in my experience, at least, and again, others may disagree here, is that SBA rates aren't necessarily higher than conventional rates. They might be a little
Hmm.
bit, but not always. There's, kind of two ways you can price an SBA loan. You can do a floating rate for the whole time, or you can fix the rate for a certain period of time. Some banks are willing to fix it for the whole, 10 years or whatever it is. And some banks will fix it for the first, 5 years and then adjust their rate after 5 years. And I think that makes a lot of sense. Doing it,
Yeah.
depending right now, it's really hard. Still people tend to pick for me, that fixed rate for those first 5 years instead of floating it, even though, rates are likely going down here. So
Hmm. Are they?
it's hard to say. Yeah, it's been really, I think any banker is going to tell you this, that pricing has been really hard in the last couple of years, and just knowing what advice to give people. And so,
Okay, so you can
oh,
do a floating rate year to year. You can do a basically 5-year fix and then floating. Can you
yeah,
do a fix throughout the whole term?
yeah, it's just whether the bank's willing to do that.
Interesting. Okay.
Not every bank is. So a
Yeah, I
lot of
get
banks
it.
only do floating. And part of the reason is because with SBA loans, you can sell off the guaranteed portion, and you can only do that if it's a variable rate loan.
Oh, interesting.
Now, I am not an expert at selling SBA, the guaranteed portion. The former bank I worked at didn't sell any of their loans, so I don't know a whole lot about that. But there's certain banks they make money doing it. So that
Okay.
doesn't mean they don't service those loans though. Still, in-house they still may service them in-house. So
Okay.
yeah,
Okay. So people might be surprised how competitive SBA financing is rates compared to conventional.
yeah,
Um, and it's probably not that hard to do. Like if they would work with you at Scale Bank or something, like talk me through what it would look through SBA and talk me through what it would look like through conventional, right? We know probably the biggest piece is probably the down payment, and that might
mhm,
be the one of the deciding factors. But a good banker, I guess, would be able to kind of say, here's the two options, or whatever
yeah.
options, and hit pros and cons type of thing.
Yeah, I mean, Brian, honestly, the type of deals I get though, very rarely am I going to say I think that, we should try to get this done conventionally. When a bank is a PLP lender and they can do SBA loans efficiently, I just think it's best for the bank and it is best for the customer just to do it SBA because they get that
Okay.
longer term. It's kind of like they're really not going to get a break in rate. It's
Got
not
it.
like comparing a 30-year mortgage to a 15-year mortgage where there's this immense break in rate where it might be worth it. I
Mhm.
just I hardly ever talk about a conventional option. I'm not incentivized to bring in
Sure.
deals based on either option. And I'm not, so my bias is not there in terms of me getting paid.
Yeah.
But that's just reality of the situation. The one thing I will say is that if there's an unsecured portion of an SBA loan, and you own a home or commercial property with 25% or greater equity, that home it will be required to be pledged on an SBA loan. So, and basically what the bank does is it just files a mortgage behind the current mortgage holder or maybe even first position if there's no mortgage. That is the one downfall I would say of SBA loans, but that is not to say that a bank may not want that also conventionally, because they're
Sure.
they're doing this convention. If they're doing it conventional, sure, they're only doing it on 5 to 7 years, but they're still going to want collateral. Maybe they're going to want you to cash secure it in some way or and secure it
Sure.
with
One
investments,
way or
but
another, they want to clutter it. But did you say if you have less than 25% equity in your home, as an example, they won't attach themselves to that loan? Um,
it's not necessarily required, but again, it goes back to,
what what they're comfortable
bank's
with, what the bank like they
discretion.
gotta, yeah, and they gotta have the
Yeah.
collateral some way,
In both
somehow.
SBA departments I've worked at in two different banks, there's definitely been circumstances where we have wanted the house on the loan, even, with it not having enough collateral or
Sure.
enough equity. Part of it, Brian, is it's psychological, you know,
Yeah.
and it's not necessarily that the bank, now don't quote me on this, but that the bank wouldn't come in and foreclose on that home and sell it, and they may, but it's a rare, you know, it's I I believe in this business enough to put my home up.
Yeah. I think that's fair. I think that's a fair,
Yeah,
way to think of it. And the banks, they gotta protect themselves too,
we're a
right?
business, right? Yeah,
Exactly. Okay.
yeah.
Anything else come to mind before we close here?
No, I would just say, use your banker, use your, especially your SBA banker as a resource, because we see a lot of transactions, and there is a reason I think a lot of people work in SBA, and we really do enjoy helping people, as cheesy as it sounds, achieve their dreams of business
Yeah,
ownership. Um,
absolutely.
so use us as a resource. Don't be afraid to ask, silly questions, because, we're going to download a ton of information to you, and it's a lot. And so I try to repeat, I'll say, if you want to go do this whole conversation over again, customer, let's do it.
Yeah.
It's a lot. So a good banker, a good SBA banker is going to hold your hand through the process and make sure that you're comfortable.
Yeah, and I would say the same thing in our role of, wealth
Yeah.
advisors, financial planners is kind of the hold the hand and see and to know what's possible, right? And
Yeah.
then partnering with a strong bank to know like, okay,
Hmm.
we can make this work type of thing. The funny thing about like kind of buying a business is like it's this roller coaster of emotions, right? Of like kind of like go back to when you were buying a house, looking at buying a house and you have to step inside the house and then envision your life inside that house with you and your spouse and your family and say,
Yeah.
oh, nope, this is definitely not the house. Oh, this one is the house. Now you put down an offer and then your dreams get crushed because someone outbid you or because, maybe you couldn't get your own financing type of thing.
Yeah.
And so I think just the approach that you take is like, to get really ahead of this um, and work with a banker to know what's possible, but also
Mhm.
just know it's probably, maybe that should be a statistic of when people start working with you, how many times does it actually play out that they acquire the business? Not always because of the banking side, but just on the seller side and negotiating the terms. But my point is like it's just a roller coaster. And if you have a partner, on the wealth advising side, but also on the bank side, it helps kind of keep those emotions in check, and you can at least know what's possible, and it's usually good experience. With
Yeah.
that said, Anne, I really appreciate your time digging deep into the whole SBA piece, but I think you said it well, like, what is possible. And these are usually people's like big dreams of what they have of maybe first, getting into becoming an entrepreneur and business owner. Or, as we found out, this could be the way that they grow and expand their business too. So that is what we enjoy too is kind of serving those business owners and helping them understand the financing options. So, Anne, Franklin, thank you for your time today.
Thank you. Thanks for having me.